Hello everyone, my name is Aaron Graham and today we're going to be taking a look at the Roth projection tool inside Holistiplan. I'm going to go ahead and get started and share my screen and we'll go ahead and take a look at what that looks like inside your Holistiplan account. Here we have Bob and Jane Roth, an allusion to Bob Roth. We're going to paint some happy little Roth conversions here today. So inside the household screen we have Bob and Jane Roth 62 and 60. We're going to go into the Roth projections menu here inside the household. It's under tax and then Roth projections. We're going to create a Roth projection. We're going to call this one the joy of Rothing. How about that? All right, the joy of Rothing. We're going to have them be married filing jointly. We're going to start it in 2025. We're going to have first taxpayer one or client one be Bob. Taxpayer two is going to be Jane. And we're going to create the Roth projection. Once we do that, you'll see that link here. Inside the Roth projection, it's all a standalone tool. The only thing it's pulling in is the date of birth so we can do the appropriate deductions, deduction amount for them for the standard deduction and any enhanced senior deduction. So where do we start? First, you come into the Roth projection screen. You see this screen. There's nothing and nothing's going to be entered for you. Let's start out with the top, and we are going to go into first the taxable assets. We're just going to assume they have $250,000 of taxable assets with $100,000 of cost basis, and we're going to assume they have $500,000 each of tax deferred assets. Now, why is it important to have all these asset values in here? We're looking at the total lifetime tax picture for Bob and Jane. Taxable assets, those are anything that's not a retirement account, anything that doesn't have an RMD or is a Roth account. So cost basis is important when we start making distributions out of the portfolio. We'll know exactly how much of a gain is coming out. Next, we have client one assumptions for Bob. I'm going to assume he lives to age 100. We're going to give him some wages. He's 62 now. I'm going to toggle over to age. He's 62 now. We're going to have him working with a $150,000 wage at a 2% clip. Importantly, we're going to end that stream of income at age 64. He's going to have $0 of income. 2% inflation will apply and save. Once we do that, we have 2 years of $150,000 of wage income. You can see it ends here at age 64. That's what we want. We're also going to add some Social Security for Bob. We're going to wait until age 70 to claim. So we're going to put in age 70. We're going to have him earning $30,000 a year roughly in Social Security, inflated at 2%. We're going to say that continues on indefinitely. So we don't put a zero row in that in for this particular income item because we want it to completely go until he passes away until the end of the plan. All right, so we've entered Social Security for Bob, again, starting at age 70, going till he passes away. Next, we're going to enter some information for Jane. She is retired, but she is earning a pension right now. We're going to add, she began receiving it this year. She's age 60. It's $24,000 a year, $2,000 a month, inflated at 2% with a 50% survivorship percentage. Apply and save. And again, this is going to go on for the entirety of her life as well. So we don't need to put a row in here with a zero because we're going to assume this continues on for the foreseeable future to the end of the plan. Social Security for Jane, let's add some for her. She's going to begin claiming at age 70, $25,000 of Social Security per year, inflated at 2%. Apply and save. So now we've entered in wages and Social Security income for Bob and Jane. All right. Spending, we're going to have them spending $72,000 a year. We're going to start it at the current year of 2025. Again, I'm toggling back and forth between years and age. You can do that inside the Roth projection tool. I'm going to put them at $72,000 a year, inflate that at 2%, apply and save. And sometimes we have advisors ask, why is spending important? Remember, we're looking at the total lifetime tax bill and the long-term implications of Roth conversions. We need to know how much they need for spending. So we're also going to assume client one Medicare assumptions. We're going to assume they begin at age 65. We're also going to assume calculate Part D. We're going to throw in $600 a year, right? A $50 a month Part D premium. Medicare going to begin at age 65 for Jane as well. We're also going to say that her plan costs $600 a year. Okay, Roth conversions, we're going to skip those for now. We're going to come back and add some QCDs as well. Let's go back up to the top and look at some general assumptions we have for them. We're going to show the RMD graph. We're going to adjust tax deferred assets. I'm going to set that at 24% For Bob and Jane, this just means that when we're looking at the tax deferred assets, we need to adjust those. They're not 100% available for spending. In this case, 70% of them, 76% of them are available for spending. We're going to change this rate of return to 6%, and we're going to have 50% of the gains attributable to growth, just meaning that 50% of the income that's thrown off of that taxable account is going to be showing up on the tax return. The other 50% is going to remain in the account, continue to grow inside that taxable account without any tax implications. We'll leave the inflation assumption at 2%. And we're going to move down here to the bottom. We're also going to throw in QCDs for Jane, and we're going to start those at age 71. You'll notice if we put age 69 in here, we're going to give you a warning. Remember, you can only be 70, you have to be 70 and a half to do QCDs. I'm going to set this to 71 just to clear that error. And she's going to do $5,000 of QCDs a year, inflated at 2%. Okay, so we've captured all of that. So as we do that, we can see pretty soon when we come back, when we make all those entries in here, we made a lot of entries. We can see that as we look, I'm going to click on these labels just so we have a more clear picture and it blows it up for us. This becomes a pretty noticeable sweet spot that we routinely see for folks of this age between when they retire, then when they begin Social Security, and between when they begin Social Security and those RMDs start. So we have a pretty good window here of opportunity to maybe throw in some Roth conversions here. So once we have those built out in the Roth projection tool, we can start looking at adding those Roth conversions. Okay, so I'm going to do that now. I do have a cheat sheet, but what I'm doing here is looking to see how much income we have or how much space we have here where we can try to see that there's some gaps. Maybe we want to fill up the 12% bracket, which goes all the way up to $102,800. $102,800. I'm going to come back in here. We're going to start adding some Roth conversions. I do have a cheat sheet here that we'll link to, but I've worked these out ahead of time just because I know what these are going to look like for Bob and Jane. And so I'm going to add in $90,000 of Roth conversion income at Bob's age 64, right? The first year he's not working. We're going to do those at a $90,000 clip. Inflate those at 2%. I'm going to add in another row here, age 71 for Bob. We're going to drop those down to 50,000. And again, if you're wondering where I get these numbers, I've worked on this ahead of time, so I know these numbers work. As you're doing this, you'll just see the gap between, where that line is that you're aiming for and what's left. And I happen to know that this works for Bob, so I'm going to go ahead and do that for him. All right, so we're going to drop it down to 0. So no more Roth conversions after age 62 for Bob. And apply and save. And we're going to start to see those Roth conversions layer in here for Bob. All right, so that's what it looks like. We're going to have conversion start and stop back through there. All right, we're filling up the 12% bracket pretty nicely. Here's another gap. Let's try to do some for Jane here. So we're going to go in here for Jane, and we're going to start her Roth conversions at her age 68, just because that's when the Roth conversions stop for Bob. We're going to do these for $30,000 a year at 2%. Then we're going to up it to $50,000 because at this point, at this age for Jane, we don't have any more Roth conversions coming out for Bob. And Social Security is kind of starting to phase in here. So we don't want to go over that 12% bracket, which is what we're shooting for in this case. At age 75, we're going to drop those Roth conversions down to $20,000. Again, she is having our RMD come out, but $20,000 on top of that is going to be roughly the number we're looking for again, because these are the numbers I looked at beforehand. So when we hit apply and save, we can see that we have some pretty good tax savings here for Bob and Jane. As we close this out, again, look, we start at age 68. We jump them up after Bob's Roth conversions are done. Then we drop them down when she begins her RMDs, and then they continue on at a slower pace. And what we can see here is that we have ended up with a situation where Bob and Jane have lowered their taxes over the years. I'm going to pull this out so we can see it. Okay, we have 2 years of working, staying just in the 12% tax bracket. 70 right here, we have a case where we've got a little bit of a Roth conversion going up over. And we come down through here. This is going to save them lifetime in taxes of almost $850,000. We're going to save them $33,000 in IRMAA surcharges. Their portfolio is going to actually jump by almost $1 million. We can see that here. And then when we look at their legacy intent, we can see here's their mix of assets before. We have approximately $1 million, a little bit over $1 million of tax-deferred assets, most of which are going to go to heirs that are potentially going to have to spend those down over 10 years due to the Secure Act 2.0. And no tax-deferred assets for Bob, but Jane has about $1 million left, and about 6.6 million in taxable assets, 2.425 in Roth, out of a total portfolio value just over $10 million. In the Roth case, drastically different, right? You can see that we have, by the end of this plan, there are no more tax-deferred assets, meaning there's no more assets to beneficiaries that have to be spent over that 10-year period. They have a whopping $10.5 million of Roth assets going to them tax-free. Taxable assets are noticeably smaller, but they have a whole lot of Roth assets that are now that they now inherit. They get to grow tax-free for 10 years before they eventually have to be paid out. RMDs we see as well have had a dramatic decrease in the RMDs that are required on the Roth case, which is in blue, versus the base case in teal. And by the time they reach age 99 or 100, which is end of life for Bob, all of their RMDs are now hit zero. So we can see that we can show our clients through the power of these periodic Roth conversions just how much value you can add to your clients, both in terms of tax savings and portfolio value, also in saving them IRMAA charges, and ultimately what they leave to their heirs if they do have that legacy intent. So that's a quick tour of the Roth projection tool. Hope you enjoy it. Hope you find it very valuable for your clients, and we'll talk again next time. Take care. Bye-bye.